After beating expectations this quarter, the outlook for European corporate earnings could also be rocky. Joining us now with a couple of charts for some summer holiday reflection is Tim Craighead from Bloomberg Intelligence. You know, Tim, this is exactly what I was wishing for the summer holiday, kind of like roundup of earnings and chart analysis.
There
Maybe if you're
go.
at the beach, please tune in. This is the right moment. What did you looking at the charts and things, like the underlying, is that it's going to be worse or better?
Well, yeah, and so shameless plug. We didn't have our reading list, but given how graphically intensive our research is, we put out 6 charts for summer holidays. So, and you know, I think one of the interesting dynamics is this issue you've been talking about, high inflation. It's not going away. We're going to stay at sustained high levels for really structural reasons beyond just simply the energy spurge. And what does that mean? You know, interest rates are going to stay relatively elevated as well. And from that perspective, we've seen an interesting dynamic the last 6 weeks since the third quarter started, and that is this move back towards growth investing, away from value investing, with the little reprieve we've seen in 10-year yields. We don't think that that lasts. We think that the interest rates will continue, as I said, to stay elevated, and with that, you know, we think a reversion back towards value makes sense and away from growth. So interesting.
It is really interesting, and I guess, can this be sustained with some of the rising costs that will pile up as we get into the winter months?
Yeah. Well, look, I think one of the big surprises out of 2Q earnings has been how good they were. And you know, hand up, they were better than certainly we had anticipated. We thought profit margins would start to show signs of cracking, and indeed, profit margins have stayed quite elevated. But if you look, 2 points. One is a lot of that positive surprise for the market, look at the stock 600 or the FTSE, in profit margins were driven by energy. If you look into 2023, though, and increasingly that's where the market's going to be focused, we have started to see operating profit margins slip in terms of expectations. We think this is the tip of the iceberg, and more that's likely to come because of elevated costs and slowing growth.
So what does that mean for safe havens among some of the European markets?
Yeah, this is one of the most intriguing elements that we've seen this year, and we think it continues. The poster child for safe haven is the Swiss SMI. But think about it, it's pharma and it's staples, that's defensive, but the Swiss currency is the one currency that's strong, and that creates a headwind, just like with the dollar. The other side, the FTSE, you think there's a lot of cyclicality here, big oil, big banks, etc. But that's where we see elevated prices, higher interest rates. That plays through well into those groups. And yes, it also has a big chunk of defensives with Diageo and Unilever and the pharmas. But there you've got a weak currency that creates this currency translation benefit. Yep. And so this barbell of the FTSE has produced a stable index.
So, Tim, what does it mean for some of the sector level drivers? Like, where do you see opportunities?
Yeah, you know, it's the one place where we see a big dislocation in terms of sector performance relative to the key underlying driver are in financials. Normally, you see financial relative performance of the market trend with interest rates. And over the course of the past 6 months or so, this is split. Interest rates are up, financial relative performance is relatively flattish. We think that disconnect comes back together. We don't see interest rates going down, we see financials trading up relative.